All right, good afternoon, everybody. Event Trader here, and we are getting set for our latest Sentiment and Flow show. It's been a little while since Brett and I have spoken, so a lot of interesting items coming across the head with the headlines and market moving activity. A lot of uncertainty out there. So, our goal today is to talk a little bit about the situation that we're facing and try to kind of figure out which direction we could go over the next couple of months. So should be a good round of discussions. We got a lot of information out there for everybody on the sentiment side of things. Certainly, some of the data flows that we're seeing out there, positioning, and where people could be on or off sides. And that's really the whole goal of this to try to set us up with either the wind at our back or understand when we are sailing into the wind. So, without further ado, I am going to bring in Brett Manning, chart trader, of course, who has always given us some nice nuggets to think about and has that outside of the box type of mentality that really could provide advantages to people on their trading style. So, with Brett, how are you doing today?
I'm doing pretty good, Gavin. How are you?
I can't complain. Can't complain. Before we break into our presentation here, I guess, what's your current thoughts on the markets right now?
Well, so first of all, you've branded me as an outside the box kind of guy, which I think fits my personal understanding of my brand. So I like that.
I'm sure I'm not the first person to brand you as such.
I don't like the box.
I didn't know, but you tend to be smarter than most of the people in the box, so that's always a
Oh,
good thing.
that's well, so you say. We'll see.
Well, I said 10. I said 10.
All right. Um. So I mean,
Well,
were you asking about today's market or just in general?
just today's market. We'll get into the general market performance
Sure.
here as we go
Yeah.
along.
So and first of all, I'm a little bit under the weather. If my voice sounds a little bit strange, I apologize, but I'm feeling all right. So yeah, I came in this morning basically with the idea that look, my my way of my understanding of markets, generally speaking, is when you get a very sharp directional move, especially in the direction of the longer term kind of trend channel, and tone of the market. Usually that's going to continue if you get lateral movement in response. If you don't get an immediate full rejection of that large directional move, instead you get some just kind of, consolidation going sideways for a couple days. That's a pretty good indicator that you're going to continue that sharp directional move. So the move we got off of the CPI number was the sharp directional move. Then, we chopped around yesterday. We've chopped around a little bit today. Um, we've seen a little bit of downside continuation. My pattern reading model would suggest that we'll see more. We may close today without seeing that. We may need another day of sideways movement. We may even flush out the top of that lateral range once more. I'd really like to see that to start shorting again because as we're going to cover, you got to be really careful when you're entering short positions right now because no matter what you do, you're going to be part of a really big emotional sweaty crowd all leaning in that direction. And we'll look at a lot of data points that kind of point to that. That doesn't mean the market can't go down. It just means the way that you craft your entries and the way that you view your setups has to take that into account. And I'd really like to see, really would like to see a some kind of squeeze like in the S&P that pops us back above 39.85 and really squeezes some positions out there and then starts to roll back over. And when it gets back below 39.60 or so after a move like that, it sort of becomes, it's on again to everybody who gets shaken out of those shorts is going to have to chase back in, and that gives you that momentum.
Now you're talking a little bit more immediate time frame on that price action, I assume.
Oh, I'm just saying, yeah, over the next, maybe sometime before the end of the week, I'd like to see some kind of violent upside shakeout that doesn't really get, establish itself significantly above 4,000. Because
Okay.
that really sets up you're still well within the process of a lateral consolidation off of the big move down, that we saw off of CPI, and you've taken some of that taken some of that leverage off the table on the short side. You've taken a little bit of the crowd out. You've rebalanced the market to some extent. You've sucked in some weak-handed longs. You've shaken out some weak-handed shorts so that when it starts to roll over, those positions reset the other way again. The weak-handed longs go scrambling to sell. The weak-handed shorts go scrambling to short back in. And those are all sell orders coming. So it's better to short after something like that where you've rebalanced the market to some extent because you're going to have this tailwind of people moving back into where they were before that upside shakeout. And in a lateral consolidation before a continuation to the downside, I've often found that you get the best setups after something that finds a key level and bursts through it to the upside and then rolls back over.
Right, which makes sense. So we'll talk about some of the things coming up and how that could potentially play out here. So first thing that we will discuss, Brett, we usually kick off with the AAII data. We usually run this show on a Thursday, which is beautiful because we generally get the most updated news from the AAII, which is helpful in understanding sentiment there. Now, there's a few ways of looking at this, Brett. I know you like looking at a couple week moving average there. So what we have here is the AAII, how it's played out over the last couple of weeks. I was a little bit surprised to see that 8% bounce back in bulls here going into this survey, Brett. I mean, there really hasn't been anything from my perspective that would lead people into that. We had the CPI print, and this data would have been taken while the CPI print was going. So, you got any thoughts on this particular weekly price move here, or weekly move in bulls, I should say?
Yeah, I mean that's exactly why I like to look at multi-week averages because this data is noisy. And so this is like 500 people who get asked, do you think the market's going to be higher, the same, or lower 6 months from now? That's it, right? That's the all of this data just comes from that. Like 500 people being asked that question. And you can imagine some percentage of those people are kind of on the fence when they answer. So, um I mean, it's noisy, but that's why if you look at sort of 4 to 6 to 8 to 10 week trends, and you get something where it's kind of consistently zone. And I would say being somewhere between 27 and 18, bouncing back and forth in that zone on the bull side, that's kind of a zone. The whole time the bears are up, 40, 45 to 50. Like that relationship has held steady for a number of weeks now, with very few really sharp moves outside of that zone. There's been a couple weeks here and there where we've moved up above, somewhere into the 30 to 35% bulls and back down into the upper 30s and bears. But it's been a long time since we've seen more bulls than bears, and it's kind of it's not festering the way it was in July, in terms of seeing, a sequence that is all really pinned down in the teens or 21 or 20 at the highest, where you really start to that's what people are doing with their money is they're not willing to stocks, and that led to the large runs. Um, but we're still in a zone where anybody who's participating in the survey, and it's been a relatively good contrarian indicator for quite a long time. So you can take seriously that it's a decent polling of market participants. That generally speaking, the average person is more bearish than they are bullish.
Yeah, it's always easier to be looking at the bad side of things, right? And we do have the 4 week average. I did throw that down there below. Brett, so as you can see, we're back above that. We're back at the level where we were really on August 24th, which would of course been right before that Powell Jackson Hole speech when it drove everything lower. Look, and as Brett was saying, there's a few ways to look at this here, and you can see, Brett, the historical average for bulls is usually around 38%, right? So we're obviously well below that. We've been trended below that for quite some time now. In fact, the last time we would have been over 38%. We don't even have that in this. Closest, the highest we've gotten was 33% back in August 17th. So you can see it kind of trails the market action for the most part, this bullish sentiment. But then the 1 year high was at 48%. That would have been all the way back in November 10th, which not surprisingly was about 2 weeks before the Fed started to make that pivot, which would have come the day after Thanksgiving. right around that weekend was when Powell started talking a little tougher. When near bearish highs, not quite at those bearish extremes just yet, but that also suggests that there's room for people to get a little bit more cautious. Now, here's the 8-week moving average, Brett, which we could kind of see what's going on there. That's been running around 24%. So, again, a little bit over that level here at the moment. And you can kind of see some of the some of the associated weekly highs and lows in the S&P and where we closed if you're trying to track this down. Now, one of the things that was interesting to me, Brett, on this bullish 8-week moving average was that we had been trending higher over the last 6 weeks in that very metric there since hitting that low around July 14th. Do you have any thoughts on that? Do you think that that's helping out your situation if you want to short a market that all of a sudden gets a pop?
I mean, I suppose that that average is an artifact of the bounce that we saw over the summer. Um, it still is well below the long-term average. It's still tough to look at it like people are offsides on the long side.
Right, right. And yeah, I mean, especially when you look at that bull bear spread, right, where you could see it running minus 25, 26% in favor of the Bears. This is down from the minus 41%, of course, that we were seeing I'm sorry, minus 19%, I should say, which is well below the minus 35% we were seeing back on the 8th, and nowhere near where those June levels were at the moment. So, interesting data points there. Anything else on this AAII data that you want to discuss that's jumping out to you?
No, I mean, I see it as we're just, it's going to match with a lot of things that we talk about in this show, which is, if the world suddenly got a lot better, everybody would be really offsides. And that's, we're going to get into some conversations about what that means, but, um, people are positioned for a certain kind of world, and for an offside sentiment picture to really pay off, you know, y- people need to be on the wrong side of what happens in the world around the corner. So this is going to match some of the institutional data we see, and we can have a conversation about where it puts our views on where the retail mom and pop investor are. And there's a bet I want to talk about, but this is just going to be kind of the landscape that we're seeing. This is relatively indicative of what we're going to talk about.
All right. So, first thing we're going to talk about here right now is the Robo Ratio, and this is your kids with calls, or in this situation, your kids with puts, right, Brett? So, what's this data telling you here?
So this is the retail only buy to open put call ratio. So it's just smaller options market participants. Generally, you associate that with being non-professional money in the options market. And we've seen a spike over the last few days to take this up. Well, over the last couple weeks to take this up to where it's higher than we saw over the summer, which is interesting. It's one of the few sentiment measures that is more bearish leaning than it was after the June crash. So it's really, up into that territory that we saw around the COVID crash. And this is, I mean, it's an important sign to see that there is smaller options market participants that are pushing so much money into puts. And there's a data point we don't have here, which I'll just describe, which is the large trader put buying. I don't know if you've been tracking that, but and I think you have to some extent, but there's one angle on it that's kind of interesting. So the large trader ratio of put spot versus calls is not at that much of an extreme level, but when you take into account how expensive puts are right now, the amount of money being spent by large market participants on puts versus the amount of money being spent on calls is at like a 25-year high. So it's the most imbalance, and the way to think about that is, um, you've got institutional money, you've got professional money that is aware that everybody's bearish and is aware that puts are really expensive and is still buying puts in very high volume. And that's, I mean, that's a level of certainty. It's like, if you just as a thought experiment, if you imagine like the face of God to appear in the sky over Wall Street one day, right? And big bearded face takes up half the sky, big booming voice, and it says like, "Behold, verily I say unto thee, the market will go down a lot tomorrow." And nobody thinks this is a trick, and everybody knows it's really God giving a market tip. You'd see really expensive puts, and people would still be buying them hand over fist, right? So this is an artifact of tremendous certainty that something's going to shift and make these bets pay off. So you get the point that I'm making. I
No,
mean, this is
I completely understand, and I think that it gets further embellished by these market makers because when they're writing the puts, their general process is to try to keep everything hedged, so everything's a little even. But when you see it falling out on that ratio so high in favor of the puts, then you start seeing that they need to scramble and hedge themselves by selling stocks, and that kind of exacerbates itself. Now it could rip the other way too, right, Brett? We saw that, I think, during the pop, and just getting an alert here uh on the S&P as that slips back below 3930. But we saw that going on a lot with the what you call it, with the Reddit names, with AMC's
oh
and
sure,
GameStop's,
the
where
gamma squeeze,
the,
yeah, yeah.
yeah, the gamma squeeze, where they were in a position that they just had to kind of follow along and buy a ton of AMC or GameStop stock, and because they were writing so many calls,
I
that they're forced into that. And that market maker aspect of it just leads to bigger moves to the downside and to the upside, and whips back. And that's part of kind of that gamma squeeze that I was talking about earlier, that's been driving a lot of volatility this week around options expiration.
Right, so there's a mechanics angle to it, but I mean, just in terms of what it tells us about where you got this sort of smart money, dumb money divide, and
Right.
where it tells us about where sentiment is. Like there, I think that what we're looking at, and when we look at the FMS stuff, we're going to see a lot of confirmation of this idea, which is the professional money in this market. These guys are incentivized not to talk about this, right? I mean,
Yeah.
first of all, like you don't very
You don't
rarely
show
do you
your hand.
hear it's not just that, it's like their business. They don't really want, as a firm, to see, the mom and pop investors start to just go on a massive uh 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 you know withdrawing all their money from all of their financial products. Like
Right.
this is bad. So even if they think the market's going to go down a lot, you're going to see uh uh downgrade to hold, right? Rather than the market's going to fall out of bed. But underneath the surface, we're going to see the cash levels are at a 22-year high in portfolios. We're going to see that this is the new all-time record for underweight equities among professional money managers, and we're going to see, as we just did, as I just talked about, that large options players are paying the most for puts that they have in as far back as the data that I could find back into the 90s. So versus how much they're paying for calls, how much total money is being laid down on put purchases versus call purchases. So the difference is the largest, larger than even during 2008. Now you could square this with market cap, so you could say by total market cap, it's actually not as much as post Lehman, but it's close right now. It's not that far off. So there's just a tremendous certainty on the part of what we would normally call the smart money, that they're, and the way that I interpret it is that we're going to see mom and pop investors start to unload equities. I think that's probably the bet, that wave hasn't happened yet and that it's going to come. I think that's what they're betting. They may be wrong, but
Well,
that's, I think, the bet.
and this entire rally from June through the middle of August, before we got that rollover going into Powell, the general thesis was that that was a lot of retail buying, and thus a lot of retail selling on this downside, while the institutional has been sitting to the sidelines, right? So
And
that's
loading up on
pretty much
puts.
being reflected in this robo. Yeah. So, and we've got a bunch of data to show everybody as we go along here. So we'll continue our move through. But let's keep an circle back to sentiment right now here, Brett, with the consumer sentiment number. I wanted to highlight this slide just because Tomorrow, the University of Michigan sentiment is coming out, so I thought it would be important for us just to take a quick preview. As you can see, consumer sentiment's close to its lowest level since 1980, and naturally, one of the key elements that we want to keep an eye out on is that inflation reading, Brett. Right? So the August survey that naturally we're going to begin the preliminary September number tomorrow. The inflation rate was around 4.8%, down from 5.2% in July. Now, that was the lowest reading in 8 months. So, this was one of the positive aspects of the inflation data that we've been getting over the last few weeks. The big item that we want to keep an eye out on is those long run expectations, right, Brett? So, we had that come in at 2.9%. But it remains in a range where it's been for the last year between 2.9 and 3.1. I know you closely follow these metrics, Brett. What's going to be the first thing you're going to look at tomorrow when that hits the wires at 10 a.m. Eastern time?
Yeah, I mean the long run expectations. We've heard Powell say he watches it really closely, and we know that they went from 50 to 75 on a hike earlier this year because that score came in high. So it's I mean this is a Fed that thinks in terms of whether or not inflation data is metastasizing into inflation expectations. That's the philosophy in play. So this is one of the most trusted sources for the Fed, whether rightly or wrongly. So it's really just about, I don't know how accurate this number is in terms of gauging that, but I know that the Fed watches it.
From your perspective, looking for a pop and a short, is your hope that we get something below that range, like 2.7, 2.8, and you see markets popping that? Is that something that you'd be looking to short potentially?
I'd rather, in coming up with the short, I'd rather find that pop by something other than a positive signal on inflation. I mean, if I could find another,
Okay,
maybe just,
that's fair enough.
I'd like to see a different headline cause that, but I would like it to be headline driven.
Yeah, yeah, like a railway unions or something like that,
Something,
something
there's a
along
nice
those
one,
lines.
sure. Something, or
Okay.
Russia, Ukraine related, or who knows.
All right, fair enough. So we'll be covering that obviously tomorrow and taking a close look at these inflation expectations, but they will be important for us to follow, especially since we got the Fed coming up next Wednesday. Now, moving on to the Fed, let's take a look at some of the recent commentary that I've seen here, Brett. For Numora, now, this is following the CPI and the direct reaction to it. They see a hike now potentially of 100 basis points on next Wednesday, then 50 basis points in that November meeting, and then 50 basis points again in the December meeting, which would bring us up to that 4.25 to 4.5, basically by the February 2023 meeting. Goldman, for its part, just on the inflation front, it sees CPI running a little bit hotter, 0.3 to zero point 0.4 over the next couple of months, with core sitting at about 5.6% year over year in December, 2.7% in December, and again, 2023, and 2.7% in December 2024. Now, one of the things that I want to point out for that is when the Fed does put out their update, they will have their new economic projections too. So that's going to be something that's going to be closely followed. Certainly the dot plots. Do you have any thoughts on any of these bullet points here, Brett?
No, I mean, I think that we've seen, the sort of terminal rate idea go from 3.25 to 3.5 up to well above 4, and who knows where it's going to go next. I mean, the way that I look at that last CPI report is when you haven't hit the peak and you know you haven't hit the peak, you have no idea how far away the peak is.
Yeah, no, exactly, and that's certainly a fair assessment of it. But I guess the thing that's interesting about this is these inflation numbers are going to remain elevated for some time, and we're going to get into a breakdown of the Goldman inflation breakdown too here in a little. So Fed expectations, Brett, the market. This is now. I think this might have risen up to 80% since I grabbed this slide here, but we got it at 76% for a 75 basis point hike, 24% for a 100 basis point hike. And as you can see, if we're just looking from 1 week ago,
It's
it's
at 78
basically
right now.
everybody that was in the camp. It It's at 78 right now. Okay, so
Right at
it's been
78.
running in that range. You've talked about in the past how the Fed usually, if something's over 60% or so, usually tends to magically fall in that
They're
area.
locked in.
So
Yeah.
are you expecting? You don't see any surprises, right? 75. I'm definitely on record. I can't see them doing anything but 75.
Well, I mean, so they've got a
D-
week. If they feel like they need to do more, there's going to be a Wall Street Journal article from that Timoreos guy saying that they're looking at 100 basis points, and then this will change. They just need to do it enough in front. It would be today or tomorrow. But if they don't do that, if we come into next week and this still looks like it is, then obviously they're accepting that it's going to be 75.
Let me ask you this: did you see Jeffrey Gunlock was out yesterday saying that the Fed should do 25
Yeah, I
basis
saw
points?
that.
What do you think the market would do if we did 25 basis points? Because for me, that would signal a big concern about econ data coming out. And while I think that would be a headline that you would love to short in that scenario myself. You got any thoughts on that thought process?
Yeah, I think one of the debates that I've seen start to emerge is this idea where there's two ways you can approach this. You can live with higher inflation for a little longer and bring it down gradually, or you can try to snuff it out really quickly. And the Fed has taken the position that it needs to snuff it out really quickly. It's coming from the standpoint that if you don't, it's going to metastasize into long-term inflation expectations, and that's a much harder beast to kill. There are people who don't agree with that idea. They just think that that's sort of magical thinking, and the reality is we can move rates up more slowly. We can weather 6 7 8% inflation for a year or two. Really, when you think about it, that tomato is going to be an extra 20 cents more expensive or whatever, and really it's not that bad as long as it doesn't turn into 10% inflation for 25 years. That's no big deal. We got to worry more about killing the economy. And I think there's two different philosophies there. And I just think that good luck is kind of that second view.
Yeah. Fed expectation cycle. This is from the Bank of America Fund Managers Survey here, where now a key thing about this survey ran from September 2nd to the 8th, so it did not incorporate the CPI numbers that we were just talking about. I'm expecting to see this 4.25 to 4.5 area that Nomura was talking about spike up to the top here and just plant the 4 to 4.25%. You got any thoughts on that, Brett?
No, I would agree with that.
Yeah, and as you can see, everything's been getting a little bit more aggressive. And again, this is before the CPI numbers,
Yeah,
so
that's the
these
big point.
expectations are in line with what we've been seeing here. Certainly, a much more hawkish Fed, which has been driving up the yields, of course, and really putting us in the position that we're in currently right now. I've seen a lot of people say that if expectations are for the rates to get up to that 4 or 5 area, Brett, that there's no way of avoiding a second test of that June lows. Would you be in that camp?
I mean, nothing is certain. So I don't know. I don't know how to interpret that. I guess maybe. I don't know.
Okay,
I don't,
no,
I don't think like that about the market.
maybe it's fair. No, maybe it's fair. So, but it's just something to kind of keep in the back of our minds as we're watching this play out, and certainly the Fed meeting next week. All right. And then just kind of we're going to pivot to this inflation story here. Obviously, Brett, inflation has remained the top tail risk. It's been running that way for a few months. It has did pull back a little bit from August, but we did see that camp kind of roll into the hawkish central banks. Now, I know you talk a lot about this, Brett, and how people are probably just given a list here, and you'd prefer to see a ranking system, but I would
Or a
combine one and
conviction
two.
measure. Yeah. I prefer to
Yeah,
see like
I would.
how sure are you of your answer? And there may be some people who are really sure, and other people are kind of like, yeah, I don't know, I can't really tell, but I'll
I
just
got
put
to
this
put
answer.
something down here, right?
Yeah,
Yeah,
like a
but
coefficient.
and really, you could kind of combine hawkish central banks with inflation staying
Certainly.
high, right? I mean, that one thing leads to the other. The geopolitical pop up here, though, that was interesting, especially when you consider Russia and Ukraine has continued to go on. So personally, I
That's
think this
weird.
is
Yeah,
more to do with China and Taiwan than Russia
certainly.
and Ukraine, and that's why I think we've seen some of those G headlines with Russia seems to rattle markets a little bit here and there.
Well, the other question is, after I mean, we've seen a turn in the narrative around Ukraine, Russia, right? You can't
Right.
not know that suddenly Ukraine appears to be stomping the guts out of Russia. And there's all of this talk about what that's going to imply. But one thing I wonder if is also behind this is, do you have an increasingly desperate and cornered Putin?
Putin. Yeah.
And what does that mean? Because that could mean some pretty crazy stuff.
Yeah. Yeah. I mean, obviously, the low hanging fruit would be cutting off all oil supplies there.
Or
Uh,
maybe a tactical nuke,
well,
or
the tactical nuke was the next step I was going to go. Yeah, so I
yeah,
mean that's not out of the question. And what? How does China respond to all this too? I think
yeah,
one of the things that's been keeping oil prices low, Brett, has been China kind of reselling all the Russian oil that they're buying. I'd be curious to see how big of an exporter China is at this point. But I did see that China did lift some of the caps on their oil
right.
producers that for what they're able to sell out and export on the open market. So
Sure, it's wholesale to retail.
it's an interesting dynamic there, and you got to think Putin and Xi were talking very closely about this in their meeting.
Sure,
So
which is today, right?
yeah, 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 which was today exactly. The other thing that I would point out too is the COVID resurgence. That's not even on the radar, and I'm pointing that out because we are coming up in a flu season. Brett, as I'm sure you're well aware of.
Mm,
Um, but you got any thoughts on COVID? You think that's kind of yesterday's news? You worried about this working its way back onto the front pages as we get deeper into flu season?
I'm really not.
Yeah, yeah, I'd be in the same camp.
There's a segment of society that needs to really worry about it, but
Yeah,
it's not an economic issue at this point.
right. All right. So again, keeping with this inflation watch, one of the key things that investors think for the Fed to pivot is going to be that PCE deflator dropping below 4%. And I wanted to point that out just because of that Goldman outlook we were seeing for CPI. I know it's not the same exact metric here, but it gives you an idea of anything falling before below 4% seems to be a little ways off. You got any thoughts on the PCE deflator, which we're about 2 weeks away from getting that number?
No, I mean, I think that 4% line feels like a level that people are going to respond to. Just it feels like the Fed has talked about 4% before, even years and years and years ago. Like where do you let it run hot and still let it run under 4%? I mean that you can kind of see the mentality around the attitude shifting completely to protecting growth and making sure the economy remains afloat if we see that drop below there. So I'm sure that's what people are referencing.
Right. And the next up, I was kind of surprised claims here, as we know that came in at 213K. So that's nowhere near the 300K. And I think you'd need to see a sustained move on that. But if you did get a one weekly print where that came in, that would be something I wouldn't be surprised to see a pop in. The high yield bond spread, I haven't seen
That's
credit acting
interesting.
up. It's
I
interesting
there
because I
oh
think
we're,
that
I,
should be
there's
higher personally.
defaults
But
are defaults are ramping up. Defaults are
uh,
ramping up.
on the consumer side of things,
No, but
be,
business defaults, yeah, business.
really? Okay.
Oh,
I've not.
absolutely. Yeah,
Yeah.
I mean, it's
Okay.
it's 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 the thing that nobody's talking about, but it's happening, and people are over levered, and when you increase the cost of capital, you know, basically you can't service new paper, and
Yeah.
you can't
Makes
bridge
sense.
yourself through, and it's happening. So that I think could become something that we see grow because I mean, if there's one way, that you
Well,
can you can
financial conditions are certainly a key element to the Fed's
Sure,
policy
and
right now.
and risk acceptance, and like if risk acceptance goes away and rates keep rising, because we're seeing some degree of risk acceptance. Turtles are still not completely in their shells in a lot of ways economically. Um, i- on markets it may be different, but economically we're not seeing complete lack of lending, etc. So, but if we start to see that, and the Fed still feels they need to ramp rates, I think you're going to see those spreads widen like crazy.
Yeah, no, which makes sense. And I would even postulate that of these five things that we're looking at, it's probably the most likely thing that we could see Powell give a nod to in his press conference next week. I'm not saying that he will, but we know number one and two are nowhere on the board. S&P 500 dropping below 3,500. We know the Fed puts kind of off the table. And these oil prices, I think anything that happens with oil prices, they're just going to look at that more as geopolitical concerns that's out of their element, really. So that'll be
Sure.
interesting to see if Powell does kind of hint at anything on that. So that would be something that I'd certainly be putting up high on the priority to listen to. Not saying that he will, but if we're looking for signs of a pivot, I think
Yeah.
that's the most likely thing that could happen in this upcoming meeting. Um, Peak inflation, Brett. We're looking at this. This is from the Fed, from the Bank of America Fund Managers Survey again. And the last time we saw these levels here would have been all the way back in that December of 2008 timeframe. This is where people think that inflation's going to be lower moving forward. Are you kind of surprised that it's this high? Do you think that we're going to see, or this high? Do you think that the CPI numbers that would have come out again after this survey will pull this down a little bit?
Uh, Pull which down?
Well, pull down those expecting lower CPI a year out. Do you think that that's going to have
Oh,
any
in other
impact, or
words,
do you think
increase expectations of higher inflation.
for more entrenched inflation,
Yeah, I mean, I
basically, right?
suppose I think that.
This tells me that most people still think inflation is going to be relatively transitory.
Yeah, yeah, I know.
Um,
I agree with what you're saying. Yeah, I would
yeah,
think that this will temper itself towards maybe. Hey, wait a minute. Maybe this is going to keep ramping up, because if it's
yeah,
really leaked into core this far and it's this broad based, and now we're starting to see, I mean, what's the upshot of the railroad strike? Like, what's the next one? People are finding new ways to afford higher prices. That's the devil in inflation. Like, if people can afford it, then the prices keep going up.
yeah, yeah. Which again goes back to the employment situation.
Right.
Here's just a number for anybody that's listened to the recording. This slide was very helpful, but it just kind of shows where the weighting is on everything, and you can really see, Brett, this owner's equivalent rent, which is the second line from the bottom there. That's been a big driver. So that's again tied to a strong employment number, and this is kind of an area where you feel like the Fed is trying to break it. I mean, it's been 65% of the CPI rise over the last 3 months there, and just continues to be a beast of primary driver, and it makes up 30%. Could you see something where the Fed maybe changes how it calculates CPI to artificially change this?
Well, I mean, that's what Europe does, right? I
Yeah,
mean, they have what is it called again? They have there's a
I,
word, I
I
can't remember
forget
the
the
name of the
term,
word.
but I know.
HIPC or something, or HICP.
Well, if you don't like the data, go back and look at it in a different way, right, Brett?
Yeah, exactly. Well, and that's why maybe alcoholic beverages have been surging.
Yeah, right. Tobacco not as big of a issue of it, but yeah, I thought that the owner's equivalent rent and then the rent of primary residency too, they are both significant pushers there. And it was interesting. I was listening to was it Barry Sternlicht? He was on CNBC this morning, and he was saying how this isn't going away anytime soon, considering he runs one of the biggest commercial real estate companies. So
Hmm.
that's certainly something notable for us to keep an eye out on. But it just kind of goes to show how entrenched things are and how difficult it's going to be for the Fed to really knock this inflation off of the list right now. So
Hmm.
continue to get markets slipping to the low side here. So we're just kind of keeping an eye out on that. I know Scott had gotten short. Um, the S&P here. We also have the XME, the metals and miners. That's slipping down to session lows as well. That's certainly tied to growth concerns, I would say. So just keeping an eye out on the markets as we go along. Brett, here's another area that we were looking at that might provide a little bit of positivity on the inflation front. And that's the global supply chain pressure index, which is run by the New York Fed, and it kind of runs in line too with what I've been seeing from the cash transportation, Brett. So. As I see this should help work its way into some of the products, but I don't know if it's going to have much of an impact on those rental numbers that we're looking at.
No, but it is. It is. I mean, it's a dynamic that's part of a recipe, and to take it, and I mean, we're starting to move back into almost sort of normal range. Another step down, and you're back kind of within. the up and down range that we've seen for years and years and years in that measure. So really, if you take that factor out of the mix, I think that that's really optimistic on the inflation front. Like that's the
Fred, let me ask
motor.
you that. Let me ask you this, because talking about the rents being entrenched and everything like this, do you ever see the government maybe getting involved and trying to pressure some of these REITs with the rental levels that they are charging, both on the commercial and real estate side? Do you see that as a geopolitical option to maybe cooling off inflation?
I mean, it sounds to me like it's really kind of similar to what we saw in the 1970s with attempts at price fixing, and
Yeah,
there were lots of attempts at that, and really, some of what we're thinking about with Russian oil fits that, except there's a geopolitical uh, strategy aspect to that. But um, people make those decisions, and generally speaking, the record in history is that you end
doesn't
up
work out.
imbalancing, based on just sort of raw economics, the way that the economic game theory landscape works, it ends up backfiring on you. So, I mean, you're going to have less supply if you start to treat that industry that way.
Right, right. So let's see, moving along. Then just with the whole inflation aspect, we just wanted to kind of take a quick look at real rates and nominal rates as they've both surged for year to date. Let me ask you, Brett, when you're looking at this, do you have any interest in the TLT or longer dated bonds as a play over equities now? Because obviously, people have got to start taking a look at bonds instead of equities as a possible area to park some money, given how high some of these yields are coming in.
I mean, I guess that, it really just has to do with your outlook on whether or not we've kind of gotten to a peak level in rates, I would think. I mean, I've, what I took some, I had a long in TLT, back in July. And I actually got shaken out of it for very little, and it went on to do better. I should have done better with that position. The position was right, at least for about a 3 to 4 week period. But that was based on the idea that we were starting to look past a notion that we'd seen the peak. We'd seen the peak in rates, and we'd maybe seen the peak in inflation. I don't think you're going to see a lot of flow into something like a long TLT until people start to feel that way.
Yeah, no, I agree with that, and we certainly haven't seen signs of rates topping yet. But just kind of keeping an eye out here on these rates and where they're moving, starting to get into that area where that's going to be a consideration for the markets, and the idea that maybe equities aren't the only game in town is going to become larger and larger. So it's a phenomenon that we'll continue to watch play out. All right, so I'll go through a couple of these charts a little quicker, and we'll come back to discuss it overall. But Brett, I'm looking at market valuations here, and this is from a recent note from Goldman. This is as of September 2nd, where they had the forward P trading at just about 17 times here, from a price to book area at 3.9 times, enterprise value to sales 2.6 times, in general line with where it has been on a historical basis. You also have the yield gap versus the real 10-year US Treasury, which is at 522 basis points. That's down at a lower level than it usually is trading at here. So on this valuation, kind of running around where we generally see things. Now, when you continue on, one of the interesting aspects of this is going to be what goes on in the upcoming earnings season and how people are looking at their earnings and cutting rates. So, right now, um, Goldman Sachs sees as a baseline of growth. This is going into 2023 of 3%. However, they do have a recessionary scenario in here of rates of EPS being down 11% on a year over year basis. So now when you're looking at the current valuations of the S&P, we got it running right around 240 times, which would put the forward PE for the overall broader market closer to 17, 18 times forward earnings. So the bottom line here is if we continue to see estimates getting cut, that's going to really take into consideration what the current valuation is. And then you look at how Goldman kind of equates it to where we're trading at right now, and at a 16 time valuation. This is assuming consensus estimates come in line. They got us at 3,900 here. You got to be trading at 17 times to get us up to 4150. So basically, what I'm looking at when I'm looking at these three charts is how are we going to be looking at valuation concerns around this upcoming earnings season if we see a lot of targets getting cut here. So, Brett, I guess my question to you is: would you, when you're expecting this upcoming earnings, and I know you're more of a macro guy, how are you going to be looking at the EPS numbers if they start coming in a lot lighter, start seeing a lot of cuts? How would that factor into your trading style?
Probably not much. But
Okay.
I mean, I get. So is this saying the third of those three charts? Is this saying that Goldman's year-end target is 4,300
That's saying it's
versus the
if it
rest of
comes
the.
if it comes in at the baseline, Goldman's year-end target for this year's 4,300.
So they're basically just saying that they're predicting there'd be a higher multiple because they're
Correct.
they're they're saying there's lower earnings, but they
Looking at
believe
it,
that.
they believe that there will be a push into the year end, from my understanding of this chart,
Mhm.
into the close at 4,300 is how
especially
they
if it
see it.
looks especially if it looks like it's a non-recession scenario. So if people are
Right,
gonna
and
pour in under those
it
circumstances.
and it's not out of the question that we have to wait and see the and we continue to break down. I know Scott's got that short on, so that's performing nicely down to the 39.10 area here. But we continue to hear commentary along lines of we're still a couple months out from getting that really negative economic data. So the way I see it, Brett, this upcoming Q3 earnings season in the middle of October, if the numbers come in better than feared and we only get that that 3% baseline scenario here for forward growth into 2023, and we're not seeing that recessionary economic data hitting yet because the rate hikes that the Fed have been putting in has not taken consideration, that I do see room for a little bit of a year-end melt up. So I can understand this 4,300 target would be my takeaway from these charts.
Yeah, well, I mean, it's certainly nobody's positioned for. I mean, if people feel like they have to position on the long side more than they are, there's I mean, we've covered some of the sentiment data. We'll cover some of the Bank of America stuff, but people are not positioned for any upside potential. So if we end up with a little bit more of a sense that there's a soft landing, Goldilocksy place somewhere in our future that doesn't include, a dive into the abyss of a deep recession in between, then yeah, I mean, I think that there's a lot of malpositioning.
Yeah, and I think that that is what this is setting up for here, where it views people more likely setting up for a recession scenario, with given how things are traded out. So, the reason why I asked that is because this Bank of America survey, obviously, the profit expectations have continued to decline here. Brett, you can see the net percentage of survey respondents saying profits will improve if it's continued to dive down, expecting some further weakness. But the PMI numbers have been a little bit ahead above that, so they're expecting PMI to follow this down, which
Yeah, and
obviously is a
remember
more
remember
negative
what we
sentiment.
talked remember what we talked about earlier about, you know, the certainty that seems to be on the professional money management side that things are going to deteriorate from here. And like when you're looking at some of this fund manager survey stuff, like you can see it come through. Like there's this is one slide, there's going to be others, but there's a tremendous amount of certainty among professional money managers that we're heading into a deterioration.
And it's amazing just to see this fall off from the tip right around that November 2021 down to this 2022. So and then obviously it plays into here, Brett, as well, the recession expectations as well, where that continues to rise. And now we're still below, but we're getting up towards that April 2020 area in March 2009. So
Mhm.
this is obviously a you can't fight the Fed scenario here, but we are getting towards those extreme levels, and you can see they don't happen very often in the market parlance. So again, this goes into the positioning where everybody's expecting that recession. The same can be said with the economic expectations, of course, where the expectations for a weak economy has continued to dive down, and that's actually below a lot of the key areas in the past that we've seen. Close to a record, it did see a little bit of a bounce up, but again, Brett, as to your point on just the negative positioning that's going on. Uh, Here's another slide on the earnings revision. And as you can see, kind of making that earnings outlook even a little bit more tedious for Q3 is the idea that energy is expected to be up 112% year over year. So we got energy up, materials and real estate is really doing all the heavy lifting. And then everything else, but just really dragging in on the market expectations there. So that's another aspect of Q3 that we'll be looking at is energy basically single-handedly keeping things up. And then if you see things along the lines of, are we going to get those windfall profits? What kind of impact is that going to have? But it certainly, or the windfall profit tax, what kind of impact would that have on the overall S&P expectations here as energy is clearly in the lead? You got any
It's
thoughts on these names here?
Yeah, I mean, it's a difficult dance because we also see, the government working really hard to incentivize more production,
Right, right,
big
and
time. Like you put the floor in the with the SPR buying leak the other day. It was pretty obvious to just say, look, we're going to be buying oil at 80. you know, we got hundreds of millions of barrels to buy at 80, so you don't have to worry. You can go ahead and start to invest in producing more because price is not going to fall below there. Like that's what they're saying, right?
yeah,
They're just saying we're going to
they're saying that,
subsidize your profits.
but also these guys aren't dumb, right? I mean, they know at some point that little carrot's going to be
Well,
taken away and the stick's going to come out, right?
yeah.
Where
So as I said, it's a difficult dance. It's what they're trying to do with sort of maneuvering and manipulating perception to try and and cap the sense of these just enormous windfall profits, but at the same time incentivize more production. Like
right,
it's
which
a tricky kind of it's a tricky
It, it
needle
it's
to
very
thread.
it's very tricky, especially when you consider we're coming into hurricane season. Now we have it's I think it's the first time we haven't had a named hurricane hit landfall by this time in a bunch of years I was seeing. So at least as a tropical depression. But if you see that all of a sudden shut in Gulf of Mexico production, Brett, that could definitely cause some haywire in the energy markets.
Well, even bigger than that. I mean, look, Russia exports like 4 million barrels of oil a day. I
Yeah.
mean, if Putin decides, the way that he's going to combat the price cap idea is just to shut that into Russia. I mean, the,
Yeah.
your estimate on the oil price goes above 200 in a day,
Right, and if people are wondering, I think the SPR, it's down to what 484 million barrels. I
which is
believe we have,
historically very low.
yeah, and the lowest since '84, I think. Right, so energy could continue to be a big area, of course. And then this is just a quick slide on what usually gets hit in recessions. No surprise, this is a good one to have in your back of your mind, and obviously it's playing out in some of the market right now. But materials tend to be hit the hardest. Consumer discretionary as well. Industrials, financials tend to take a beating there. So
Cyclicals.
yes, cyclicals, exactly. So not that that's really breaking any new ground here, but just this kind of puts a dollar or a figure on how big those earnings could get hit, and certainly
I'll tell you
materials.
though, this will be maybe the first recession since 1980 that it could be stagflationary.
Yeah,
So this data set is biased in a way. I mean,
right. Okay,
if you have
that's
the
fair.
prices of if you're in recession because oil's at $200 a barrel, and who knows what happens to copper or whatever. Like if you have an inflationary environment with a recession, this table probably looks a bit different.
Yeah, no, that's fair. But these are this is a good way of just kind of keeping those industries in front of you here as you're trading along. Here's the S&P multiples again versus the 10-year real treasuries, and you can see the 10-year real treasury rate running a little bit above that here with those S&P multiples trading around what 16 and a half times here. So again, just watching to see real the real 10-year treasury yield against S&P 500 multiples and seeing when people are going to start switching over to the bonds. And then we got the equity allocation. Brett, this is another slide from Goldman Sachs. This would have been as of September 2nd. Uh, so close to the tech bubble peak on equity allocation. Investors have allocated 47% of their financial assets to equities. So again, this just kind of rolls out the idea of people really positioned heavily in equities that we could see some further selling. You're seeing this cash position rising, debt falling. Funnily enough, I guess that's what the higher yields people a little bit more concerned
Hmm.
of holding that debt. Brett, would that
Well,
be
the
the way of
value of it.
looking
This
at
is the
that?
value of it, probably.
Yeah,
The
yeah.
value of it's declining.
But again, it's one of those things that there is the potential there for equities to fall given positioning.
Well, this is
Uh,
this is kind of what I'm saying about the face of God
yeah,
appearing in the sky above Wall Street. Like, I think that it's charts like this that point to why professional money managers are spending more on put buying right now than any time in 25 years. And why we see the highest cash position and the most underweight. It's that the hedge funds and professional money managers, they're already basically at whatever they get to that defines their idea of being out of stocks to whatever relative extent that is. And they think that the mom and pop investors are now going to make the same transition. So this
yeah.
shouldn't be there. This shouldn't be near where we were in 2000,
Right, right.
given the circumstances.
Yeah, and I mean, it's just something that we'll be continuing to follow here. And again, the cash balance is spread at 6.1% in September 2022, highest since October 2001. This is, again, the Bank of America Fund Managers Survey. And once again, this was before that CPI number came out.
Hmm.
So chances are this could be even higher than that, right? You'd figure.
Yeah.
Okay. S There's investor, positioning again, just kind of falling in to that negative sentiment position here. This is Goldman Sachs look at things, where it's 1.4 standard deviations below the average. So obviously much higher, but we have seen more extremes on that.
I wonder how this is constructed, but I guess we'll never know.
Yeah. Yeah, but just kind of bakes in everything here, what we're talking about. And again, ownership of U.S. equities since March of 1945. I just thought this would be a handy chart for people to be aware of. Households still hold 38%, but you can see the growth of passive mutual fund ETFs in there, active mutual fund ETFs, the growth over through the years. I mean, this chart goes back to 1945. You can see the other things were barely a blip on the radar at that point. You also have your pension funds and government retirement funds, which really hold a lot less than they did back in 85 to 90. Foreign investors, a much larger piece of the puzzle here, too. So, when you start seeing potential for global recessions, that needs to be factored in. But I thought this was a pretty interesting chart and just understanding where ownership is in the market, which U.S. equity market stands at about a $76 trillion value here. Uh,
And households are at 38%.
and then households are at 38% of that. So pretty big number there. Uh, Asset allocation again. This is from the Fund Manager Survey. Asset allocation to global stocks at an all-time low. Brett, I know you've been talking about the emerging market play. Is this something that kind of factors into that?
For which, sorry.
With asset allocation to global stocks at an all-time low among fund managers
Yeah, I mean,
surveyed.
it's part of it. I mean, it's just, I mean, especially when you look at the emerging market space, you see like, I mean, the level of appreciation for the potential for companies in emerging markets to do well over the next 5 years is off the charts in the basement. And probably some of that. I mean, we've got the potential for famine conditions and just a complete destruction of the ability to gain access to dollars. And there's all sorts of factors that are part of that. But we've gotten to some kind of stochastic basement place in terms of allocation there, and I'm pretty certain of that. It just depends on
Timing.
it
And,
just depends exactly. And I really personally, I think it's going to have a lot to do with where the U.S. dollar, the Dixie chart goes.
yeah, and we'll get into that in 2 seconds. Again, investors cut to underweight to a stock to a record high. So this again factors into that positioning with the dollar and everything, or with the cash balance. Here's where investors are most underweight at the moment. Again, Bank of America Fund Managers Survey, equities. This is against historical averages. Tech, U.S. So all big drop offs there.
What's the most, right? Most
Yeah,
underweight
most
in the
underweight, and
survey's history right now.
everybody jumping up into staples, cash. Banks actually still overweight. Energy, of course, commodities and materials. But again, with that materials, that's where you could see potentially a fall off if we start running into recession. So just kind of keep that in the back of your mind. As Brett said, this could be a different type of recession, but when you're just looking at price action there, keep that in mind. And here we are on the dollar, Brett. So there is an interesting aspect to this. Of FMS investors see the U.S. dollar as the most overvalued on record, against other currencies, the most undervalued. So this kind of factors into that EM play that you were talking about. But the flip side of this is, okay, so it's overvalued. That must mean everybody's running from it. No,
Yeah.
the most
No. Right.
crowded trade over the last 3 months has been the U.S. dollar, more so than long oil, commodities, ESG assets, naturally tech, everything. So, Brett, how do you match up those two aspects there
Well,
in
there's a little
terms?
trick. There's a little trick to the that second statement. So
Yeah,
when this survey says what the most crowded trade is, it isn't saying what the most crowded trade is. It's saying what the most people say they think the most crowded trade is. Right? And
right,
there's a huge difference there. They're not polling the holdings and finding that everybody's long dollars and therefore it's the most crowded trade. They're saying to fund manager Bob Johnson, "Hey Bob, what do you think the most crowded trade is?" "Well, everybody's too long the dollar. It's got to be the dollar." Well, there's a good chance Bob's not long the dollar then,
right. So
right?
he's trying to talk it down so he could get
Well,
in.
he's I don't know, but he's making an estimate of what he thinks other people's positioning is.
Yeah, no,
Right?
that's
And
fair.
that's different from every other question in the fund manager survey, which is all about, what is your positioning? And this is speculate on what do you think other people's positioning is. And so it's a fundamentally different question. So that may account for this, and that actually it's not the most crowded trade. That people think it's overvalued, they're not in it, and they just assume everybody else is. Now it could line up just like when you see anything that's screaming higher, like a few years ago it was certain areas of the tech sector. There was a period when it was Bitcoin, as it was at 70,000 or whatever. I mean, there are just there's just an instinct about something that's been diverging from expectations in a parabolic rally, that must be the most crowded trade because I talk to people, they're all into this momentum trade, blah blah. Who knows what reality is, but there's definitely a distinction there, and the dollar's been crazy strong.
Right. So, well, it's something that definitely bears watching. Obviously, people continue to pile into it given the price action there. Interesting to see long cash on this most overcrowded trade. I don't know if I've ever seen long cash in on there, but again, it just kind of highlights the people heading to the sidelines just to
Right.
stay away from some of the volatility.
Especially in an inflationary environment.
Yeah, exactly. All right, Brett, I'm just going to fly through this just to kind of try to explain, some of the reasoning behind why we've seen so much volatility the last few days and so much choppy action here. And that's Friday, we got quadruple option expiration. This is the largest in the last two Septembers. Now, it's not as big as the June one was, but every quarter you get the quarterly expiration, the daily, the weekly, and the monthly expiration. So that's where you just tend to see a lot of activity going on, a lot of hedging by these market money managers in terms of even either having to sell against um, a heavy put position or buy against a heavy call position. And that's kind of why you see the gyrations of jumping up and jumping down around this quarterly event. It just means that there's a lot more of that the money that the market makers have to do in order to hedge their position. This is the size of what we're looking at. There's 3.2 trillion of notional options expirations that are going to expire on Friday. 1.7 trillion are in the SPX. There's 250 billion in the E-minis, non-SPX index, down to 110. I would point single stock down all the way here at 505 billion, Brett. So this kind of plays in. We're talking about it with the SPY indicator that you like to use, where people tend to be a little bit more cautious in their positioning and look at the bigger liquidity of the indices in order to take positions. So this stock right here, number one, shows you the size of the money that's at play, and then also kind of the idea of the positioning where people are bearish and looking to avoid those single stocks, especially when you factor in a lot of it's coming from the retail side. Now, when you're looking for the expiration, where's most of these set to expire? You could see the 4,000 areas where you have most of the open interest. So this is kind of why I'm watching this level here to see if people try to drive that up by that area here. But you can see a lot of money is focused around the 30. 800 to the 4100 area here. This would be, puts that could have been bought a while back at the beginning of June or what have you. But it's just interesting to see where this stands right now going in and what kind of some of the mind thinking will be. This is why I'm thinking that we're going to try to see them drive it up to that 4,000 level. Now, maybe they tried to get up there up to 39.75 and fell short, but that's a dynamic that I think that we need to pay attention to. How it plays out, I don't know. What remains to be seen, but it just kind of helps point out why there's so much volatility and shakiness in the markets right now as this sets to expire. Brett, again, here is a chart showing the index and ETF puts. You could see all the way up here at the top of the level, the highest one, then the index ETF calls. So as you can see, a lot more puts are going to be expiring. And then all the way down here, you could see that decline in the single stock calls and single stock puts, Brett, where, for a while there, single stock calls were running above those index ETF calls, and now you've seen that reverse lower. The puts activity, you haven't seen as much action going on in there in some of these. So it seems like people on the institutional side, at least, Brett, are probably doing a little bit more activity hedging with the index puts more so than individual calls, I would say. And moving along here, this kind of just shows again another way of looking at it. You can see those big pop-ups on the quarterly, just so you can understand why there's so much more activity going around on the quarterly expiration, why these quad expirations are so important. The next one, of course, will be coming in December. And December tends to be the largest because you also get those yearly puts. What are the ones that Pelosi's husband likes to do with
You mean the
those?
leaps?
The leaps, yeah. So they start getting factored in. So you can see these December numbers tend to run at the most. So, and that's going to be coming in right around a Fed meeting too, when these set to expire. So it's going to be a lot of volatility in that time frame in December. Um, Here is just kind of a look again at options compared to futures and ETFs, and you can get an idea of how much bigger the options market is here, Brett. People aren't going to futures to trade; they're not. They are using the
Or
ETFs, but
shares?
or shares.
It's
They are
all
going.
options now.
They
Yep.
are going to options, and
You
this is
can lever your
the
money more, and there's a lot of education out there.
Exactly, and that's why it's so important just to kind of follow the options market, just the amount of volume that's going in here. So, I just wanted to point that out. It's a very 3,000 foot level, and look at the options, but just to kind of try to help you understand why this options expiration, you're seeing all this volatility here. There's a lot of market makers that need to kind of position themselves and hedge themselves in order so that they don't take a bloodbath on any of the calls or puts that they'd been underwriting over the last couple of months here. All right. So Brett, we covered a lot today. We hadn't spoken in a while, so I thought it was I thought it was good that we cover a lot of
Sure.
different aspects of the market. But my primary takeaway is that things certainly still remain pretty bearish out there. We see that in the sentiment, but there's a lot of big aspects coming in. Q3 earnings season certainly being an important one for valuations. The inflation data naturally is going to be something we're going to continue to follow. The reaction to economic data, and is bad data good? That's going to be another aspect to the markets that we're going to want to watch. But I guess the key thing is, while things certainly look ugly out there, you have to understand that there is a pretty strong positioning in this, and sentiment remains fairly embedded in that. So if we do see Q3 earnings beating expectations and the dreaded better than fear, and we see some signs of inflation cooling off, and we don't see economic data falling off the table, which leads to the story that, hey, maybe the Fed is going to get the soft landing, then there is a scenario in the markets that could certainly lead to a little bit of a bleed up higher into the end of the year. I would be cautious on such a move, but looking at all this data, that's kind of what I'm seeing. But I want to know, Brett, what you are seeing and how you're kind of thinking of trading this.
So I think we've got a really difficult market to trade. And it's difficult because it's already very much crowded on the bear side, and yet it's probably still going to go somewhat lower. And that's a tough scenario to trade. To trade with a crowded side of the market, it's real easy to get burned, and it's really tough. You really need to find specific opportunities, and you need to stay very disciplined. Right now, the if you look at the market as kind of this divided notion where you've got professional money and retail money. The professional money, there's all sorts of markers that suggest it's extremely certain that the retail money is overly allocated to equities, and that's going to change. And the professional money's betting on that really hard right now, and so there's a tremendous amount of positioning around that concept. And I would say that there's a couple reasons for that. One is, as we showed in the chart earlier, that the household exposure to the equities market is still very high as a percentage of total assets relative to history, even though we're in kind of a difficult situation. And the other side is, the Fed's given the Fed's philosophy and the philosophy that it has expressed and said it will align itself toward, it's in kind of a checkmate, and the economy is in kind of a checkmate because the Fed is going to have to deliver some pain for things for it to achieve its objectives, and it's willing to do that. And there's been a lot of points made by Powell and others that you have to go through short-term pain to get to a situation that provides us with long-term prosperity. And so if you're positioned for the market over the next 12 months, that's when that pain's going to be delivered. And so if you've got, let's call it just, I don't like this term, but we'll call it the dumb money is positioned too long the stock market, and the Fed is in this checkmate, and the professional money is loaded up on bets that those are going to add up to only one thing. That's where we are right now, and it's possible that all of that money turns out to be wrong, and we start to see some improvement in the next inflation data is much better than expected, and the Fed starts to say, we're maybe overly stringent on the notion that we need to get inflation all the way down in the next couple quarters. There's ways in which that bet could suddenly scramble itself out, but otherwise you're going to be in a market that probably has some downside to it, but it's going to be difficult to take advantage of because so many people are already leaning so hard on it. So you just need to be really tactful in how you play that.
All right. I think that's going to do it for us here then, Brett. Any other parting shots, or do you think you got everything in there?
I think so.
All right. I know that there's a few feedback questions here, so we'll do our best to get around, make sure that all questions are addressed. If there's anything else, definitely feel free to write in. Again, we did record this, so I will be posting this to the site in a little bit. We appreciate everybody listening. Brett, as per usual, always a lot of fun talking to you about the markets out here. We will be shutting down audio just for a couple minutes so I could stop the stream and then restart it. And I'll jump back on. There's Adobe, as we know, came out prior to the market, so no big earnings in the after hours, so it should be pretty quiet. But I'll just talk in and see how we finish up the day, and then provide a little bit of a precursor to tomorrow with that University of Michigan sentiment, and of course, a big quadruple options expiration day. So, Brett, thanks again for joining us here, buddy. We look forward to continuing to follow your commentary and look for your trading setups here, as they tend to make us a good amount of money. So
All
always
right.
much appreciated.
Well,
All
thanks a
right,
lot, Gav.
no problem. We'll talk to you soon. And everybody, I'll be back on here in about 5-10 minutes.
All right. Take care.
Bye bye.